What's up, everyone? Erik from Outlier Trading YouTube channel. I want to talk to you today about naked puts. No, you're going to have to keep your clothes on, but we can talk about selling puts using margin. That's the goal for today. So we have three things I want to cover: what the structure is, how the structure behaves, and then three different ways you can use them. Because I think for a lot of people, it's kind of a misunderstood strategy. Some people think that you only sell puts if IV percentile is high. And believe it or not, some of the best periods to sell puts is actually when implied volatility percentile is low. And I'll talk to you about why that's the case. Before we get too far into the weeds, though, we got to start with everybody's favorite disclaimer. So as I already mentioned, I'm from the Outlier Trading YouTube channel, which means I'm not a part of Barchart, not affiliated with them. They're friends that I enjoy making content with for you. The other thing here is I'm just a dude behind a screen. I'm not a financial advisor providing any sort of financial advice. This is all just general information to provide tools for people to integrate into your tool belt, hopefully to help things along and your process through markets. So let's start with a review of the structure. And the cool part here is the structure is super simple. You'll see it's just a short single option. In this case, it's just a put. We sell to open a put option. Now, why would we do this, and what's the difference between a covered or cash secured put and a naked put really comes down to the backing behind the trade. So if you sell a put to open and it's cash secured, that means that you have the capital set aside to take the entire position if you were assigned. So let's take a look at an example together here in Airbnb. And if we take a look at, let's do these side by side. And if we take a look at this expiration cycle, we'll go a little further out to the 20 SEP. And let's take a look at these 100 strike options, and let's look at the put side over here. So in this case, if you sold a cash secured put here, that means that you would need to have the capital available to buy 100 shares of Airbnb if you were assigned at 100, which would be $10,000. That's cash secured or covered. When we're selling them naked, the only thing that you have to put up is the margin required by your broker, which is a much smaller subset of that $10,000. It might vary slightly by your broker and whether you have regulation T or if you have portfolio margin, which tends to give you slightly better margin rates. But the real difference here is that when it's cash secured, you have the entire cash set aside to take this position on if you have to buy the shares. If you are selling naked puts, it means that you don't have the cash set aside and you're just using and offering the margin to maintain the position. Now, a couple quick notes on that. As the position moves, the margin requirement is likely to change, especially if you're on portfolio margin, because your broker is going to require the amount of money that they perceive as the risk. So it's important to account for that before you place anything that's not cash secured. The other thing is that depending on your broker, if you have margin, but let's say that you want it to be cash secured because you're going to use it to procure the stock, you want to buy the stock by selling puts. Well, the broker doesn't do that for you. There's not like a selection box. I want this to be cash secured or naked. If you have margin and you're trading in a marginable account, if you're trading in things like IRAs, they have different rules. You can't sell naked puts. They're automatically going to be cash secured. But if you're trading a standard margin account, then the broker is automatically just going to require margin. So then if you wanted it to be cash secured, you, the trader, have to account for that on your own. So you have to pay attention to that. Okay, so we now know what the structure is. It's about as simple as possible. Let's talk about what it looks like. So this is, again, using a different stock, using Novavax, but I'm just giving you an example of what it looks like. And there's a few things you'll notice. This is the P&L graph. So your y-axis is your profit and loss. And then the x-axis down here are the different stock prices. So stock is going up this way. When we go to the right, stock is going down when we move to the left. So one thing you'll notice is there's two lines, blue and purple. That blue line simply represents at expiration. And then this purple line represents today. Why are they different? Because of time. As time passes, this purple line will approximate to that blue line. So that's why there's a difference here. So let's talk about what this looks like. You'll notice that it has a steep sloping line down to the left. This signifies that we technically have an undefined loss structure. Now I say technically undefined because we refer to that colloquially. However, it's not actually undefined. A stock can go to zero. So that's essentially where it would be eventually defined at. When we use undefined in options, we really are just referring to very big moves, and lazily so by calling it undefined. Now, for the profit side, you'll notice that it gets to this level and then it just flattens out. That's defined profit. So how does this transaction work? Well, when you sell to open this option, you are going to collect a credit up front. That credit is your max profit. So going back to this example with Airbnb using these 100s, if you sold to open a put in this trade, let's just call it 80 cents, something towards the mid between the bid and the ask, and it was the last, so we'll just use that, 80 cents. That means that that $80 you collected, that is your max profit. You get it up front. So why would we do that? Why would we take a trade that has unlimited downside potential and capped profit potential? Well, it's because it provides a couple really cool things. The first thing is you'll notice that I said that this purple line will approximate to that blue line. Notice how when we look at the price of the underlying, when I took this snapshot, Novavax was trading right here. This is the current price of the stock. So you'll notice that it can actually move against us and we can still make money. That's because you collect a credit up front. So that's one of the cool things. Your break even is at your strike price less the credit you receive. So it gives you a buffer. The other reason why this is kind of an interesting position is because it puts you in a position where you are long theta. You collect the passage of time, whereas buyers pay it. So again, coming into something like this for an example, if you expand the Greeks on each of these options, they will each have things like delta, gamma, theta, vega, and theta will tell you essentially how much money these are going to decay on a daily basis. But if you sold them, you're collecting that decay. So let's talk now about their use cases. And there's three big ones as far as I see it. The first one is if you have a bullish, slightly bullish, or neutral disposition towards something. Why slightly bullish? Well, let's say, for example, we're looking at Airbnb and you saw that it had this big drop. You thought that that drop was overdone and it seems to just kind of be trending sideways. This isn't necessarily where I would want to buy shares because it's not going up. And if I buy shares, I need it to go up. But if I think it's more likely to trend up because it's basing out here, then maybe I sell a put. So I'm still moderately bullish. My disposition might be that I think it's more likely to go up than to go down, but I'm not fully bullish because it's declining and it's not going up. So you can use something like short puts to trade those kind of middle grounds where you have a slight disposition towards something or even a neutral disposition, meaning I think it might just continue to consolidate here and go sideways. That's another completely viable disposition to trade via short puts. So that's a really simple first reason to trade them. The second is if you're trying to trade things like early reversals and you're not confident on where the underlying is going to go. So in this case, it obviously dropped off and we might think that this is likely to go up. Let's say we have a bullish disposition in Airbnb, but we don't really know when it's going to happen. But maybe we want to buy shares ultimately. But in the meantime, we want to collect the second thing you'll notice here on this, well, third thing is positive theta. We want to collect some time while we're waiting for this thing to go up. So what you can do is you can say, well, I'll sell some puts and maybe I'll wait and get a sign that way. I actually think it's a big mistake when people attempt to build a position in an underlying by selling short puts, but that's the cash secured route, completely different. In this case, again, we're not looking to take assignment, we're looking to trade the position in and of itself. So in this kind of scenario, you can trade an early reversal if we thought Airbnb was going to go up, but we don't know when it's going to happen. We expect to buy shares when it starts to break out, but until then, we still want to maintain some sort of bullish deltas. So you can do that via a short put. Now, there's one other thing that's not listed on here that's probably one of the most important aspects about short puts specifically. And it's the fact that short puts, put options in most products are overpriced. So what that means is relative to their theoretical value, they tend to trade more expensively. That's because the market fears the downside more than it appreciates the upside. That offers an opportunity to sell things that we know in general are overpriced. This is called variance risk premia. Risk premia, there's different kinds of risk premia, but VRP for short, variance risk premia. So we can benefit from that overpricing of options in this example while capitalizing on some of these other traits that we might want to add to our portfolio. Something that has positive theta, something that doesn't require a big move in our direction. Now, like any other trade though, naked short puts or naked options writ large, they require careful management. And it's because in this example, well, let's use Airbnb. In this example, you're only collecting $80. That's your max profit. What you don't want to do is take in that $80 and then have something that moves against you massively and you accumulate a huge loss trying to make just $80. These are typically higher probability plays because you get to go out of the money, meaning you get to move away from where current price is. And again, that's what gives you this buffer. That's what lets you be wrong a little bit before you start to lose money at expiration. Careful dance here, because you'll notice that this purple line is downward sloping earlier than that. So you have to figure out the way you want to manage these trades before you put them on. Because you might say, well, I'll hold it until break even. Well, now you're at a weird point. Because if you hold it until break even, you're showing a much bigger loss than it would be if it stayed there at expiration. But if you don't manage it, then it might keep moving. So it's really important, in my opinion, to kind of develop the way you think you want to trade the position. So in this case, using Airbnb as an example, I would just use standardized support and resistance. I would say, okay, I think that the floor is baked in right here at 110 or 111. If it falls below that, then I'm directionally wrong on my trade. I'll accept the loss and I'll move on to something else. So it gives you a bit of a buffer, but I wouldn't take it for granted and let that loss build too much. It can become a giant problem as people tend to allow losing trades to expand too far. We actually covered this in the last video I did with Barchart that I think you should check out. As always, if you have any questions, let us know in the comments. Be an outlier. We'll see you guys later.